Today I'm revealing 10 Canadian ETFs paying over 10% yield that I actually hold in my portfolio. And before we dive in, please note that all yields mentioned in this video can change and are based on data as of October 2025. So always check your current yields and do your own research before investing. All right, these aren't ranked from best to worst. These are just simply the 10 ETFs that I personally hold, and we'll break this down into two parts. First, my top 5 monthly paying ETFs, and then my top 5 that pay me twice per month for even more regular cash flow. So let's get started. First up, we have Bank from Evolve ETFs that focuses on Canada's big 6 banks and insurance companies with a covered call strategy, currently paying around 15% yield. What most Canadians don't realize is that Canadian banks are among the most stable and profitable in the world. And Bank boosts that income through selling call options on up to 33% of the holdings, plus it uses 25% leverage. The tax advantage here is that you're getting Canadian dividend paying banks, which qualify for the dividend tax credit, plus the extra income from selling those covered call options. So for higher income earners, this creates a powerful tax efficient income stream, and it's best for conservative income investors wanting Canadian banking exposure with higher yield. But the main drawback is if Canadian banks underperform, this fund will feel it since it's concentrated in just one sector. Next up, we have HYLD from Hamilton ETFs that holds a mix of Hamilton's own covered call ETFs and currently yields around 12.7%. The big advantage is that you're getting income from broad S&P 500 like exposure through Hamilton's yield maximizer ETFs that cover different sectors. HYLD gives you a one-stop solution for diversified US market exposure with covered call income. Instead of buying multiple sector-specific covered call ETFs yourself, HYLD packages them together to mirror the S&P 500 sector weights. It uses 25% leverage to boost yield and growth potential, making it a higher yielding alternative to the S&P 500. Third is UTS from Evolve ETFs, which holds Canada's top 10 utility companies and boosts the yield through covered calls and 25% leverage, currently paying around 17% yield. Utilities are recession-resistant businesses that people need no matter what's happening in the economy. UTS gives you exposure to essential Canadian infrastructure like utilities, telecommunications, and pipeline companies. The covered call strategy applied on up to 33% of the portfolio boosts what are already typical reliable dividend payers. Since this fund launched in September 2024, it's still relatively new, but has shown strong performance with a year-to-date return of over 17% as of September 2025. Best for very conservative income investors wanting utility exposure with higher yield. And fourth is HHIS from Harvest, which pays around 22 to 23% yield and offers both growth potential and higher income. The strategy combines growth-focused single stock ETF holdings with aggressive income generation through option strategies and 25% leverage, again, on those underlying ETFs. HHIS is a one-stop solution that holds a mix of Harvest single stock ETFs, giving you exposure to trending US companies like Microsoft, Netflix, and Nvidia. The fund launched in January 2025 and has already grown to over $500 million in assets. Since it's only been around since January 2025 though, it's still building its track record. But the heavy focus on tech and growth stocks makes it higher risk, so I recommend it for more aggressive income investors. Rounding out my top 5 or my personal 5 monthly pairs is HDIV from Hamilton ETFs, which is the gold standard for diversified covered call exposure with a current yield of 10.96%. What makes HDIV special is its broad mix across multiple sectors while using a smart covered call strategy. HDIV has consistently paid stable distributions and has beaten the S&P TSX 60 by 2.99% per year since it started in July 2021. HDIV doesn't put all your eggs into one basket. It spreads risk across financials at 34.2% in tech, 14.6% in utilities, 13.3% in energy, 13.6% in gold, 13% in other key sectors. This diversification combined with income boost from covered calls and 25% leverage creates a strong risk-adjusted return profile. Best for investors wanting diversified covered call exposure to Canadian stocks with that tax efficiency and excellent core holdings in any covered call ETF portfolio. And very quickly, I've noticed that over 80% of viewers who watch this channel aren't subscribed. An easy way to support this channel for free is hitting that subscribe button. Now, let's move on to the ETFs that pay twice per month, giving you even more regular cash flow. Perfect if you're looking for more frequent income to cover the bills or reinvest more often. First, in my twice monthly category, it's S-Day from Hamilton ETFs, which launched in July 2025 and uses a 0 DTE options, that's 0 days to expiry options, to generate higher income. This is a much more aggressive strategy than traditional covered calls. And here's how S-Day works. The fund invests in SMVP, which is the Hamilton's US Equity Yield Maximizer ETF that holds quality US dividend paying companies. Then Hamilton sells 0 DTE covered calls on the S&P 500 index, targeting roughly 20 to 25% of the fund's value. The key innovation is that they sell options that expire the same day, capturing short-term volatility while staying fully exposed to overnight returns, which historically is where most market gains happen. The fund uses 25% leverage to boost returns. Payments go out on the 1st and the 15th of each month, and this fund would rank higher based on its innovative approach and strong yearly returns, but it's still a very new fund, launched in July 2025, so we need more time to properly judge its performance. And second is Q-Day from Hamilton ETFs, which also launched in July 2025 and uses the same 0 DTE strategy but focuses on technology. Q-Day invests in XLK, the Technology Select Sector SPDR fund, giving you exposure to leading US companies. And Hamilton then sells 0 DTE options on the NASDAQ 100 index, targeting roughly 20 to 25% coverage. Same structure, options expire the same day, capturing short-term volatility while keeping full overnight exposure. The 25% leverage boosts both income and return potential, and early performance has been strong, but once again, S-Day is too new to have a full market cycle track record. But the aggressive option strategy and tech focus make this higher risk, though the twice monthly payment structure provides more regular cash flow. And third is C-Day from Hamilton ETFs, completing the Daymax trio. C-Day launched in 2025 of July and applies the same 0 DTE strategy to Canadian stocks. C-Day invests in CMVP, the Hamilton Canadian Dividend Index ETF that tracks quality Canadian paying dividend companies, which has historically beaten the S&P and TSX 60 with lower ups and downs. Hamilton then sells 0 DTE options on the S&P 500 index, targeting 20 to 25% coverage. Since daily options are currently only available on select US indices, C-Day uses S&P 500 index options, even though the actual holdings are Canadian. This combination of quality, dividend payers, and 0 DTE strategy and the 25% leverage creates a strong income solution. And like other Daymax ETFs, it's showing strong early performance, but once again, it needs more time to build a proven track record. And now fourth is Biggie from Evolve ETFs, which launched in September 2025. As part of Evolve's new Ultra Yield lineup, Biggie invests in leading US companies and uses a covered call strategy with leverage of up to 33% to generate higher income. Biggie holds an equal weighted portfolio of leading US stocks. The covered call strategy is applied based on market conditions. And what makes Biggie unique is twice monthly payment schedule like the other ones. And the fund is extremely new, once again, having just launched in September 2025. So we don't have the full yield history just yet, but early signs suggest it will deliver competitive income. And then finally, we have Canny from Evolve ETFs, which is Biggie's Canadian version. It also launched in September 2025. Canny invests in leading Canadian companies with the same covered call strategy, leverage up to 33%. Canny holds an equal weighted portfolio of leading Canadian stocks with good option income potential. And like Biggie, it pays twice per month and uses an active covered call strategy. The Canadian focus makes it a great match with US focused twice monthly payers, but it did launch in 2025 and we're still waiting to see its full performance picture. So my core holdings include Bank for Canadian banking stability, HYLD for diversified US covered call exposure, UTS for utility sector stability, HHIS as a higher yield position with growth potential, and HDIV for diversified Canadian stock exposure. Then I have my twice monthly pairs, S-Day, Q-Day, and C-Day as more speculative positions because while 0 DTE strategy is innovative, they launched in July 2025 and are simply too new to properly judge. And Biggie and Canny are even newer, just launching in September 2025. And before we wrap up, I want to give an honorable mention to HHIC from Harvest. Now, I don't currently own this one, but I'll most likely be holding it by the time this video goes live. HHIC is Harvest Canadian High Income Shares ETF, and it's basically the Canadian version of HHIS. While HHIS focuses on US single stock ETFs like Microsoft, Netflix, and Nvidia, HHIC does the same thing, but with established trending Canadian companies. It uses the same active covered call strategy with around 25% leverage to generate that high monthly income. And what I really like about the HHIS and HHIC combination is that you get the high yield single stock ETF strategy across both the US and Canadian markets, giving you geographic diversification while keeping that aggressive income generation approach. HHIC also launched in August 2025, so like many of the funds I've mentioned, it's still very new and building its track record, but the structure mirrors the successful HHIS approach applied to Canadian blue chip companies. So this shows that there are many different ways you could split your money between these depending on your investment goals, your risk comfort level, and income needs. Some might want to focus only on the more established monthly payers like bank, HYLD, and UTS, and HDIV for that stability. Others might want to add some twice monthly pairs for more regular cash flow and potentially higher yields, accepting the additional risk that comes with these newer funds and more aggressive strategies. The key is understanding what you're buying: monthly versus twice monthly payments, established funds versus new launches, focus sectors versus diversification, and moderate covered call strategies versus aggressive zero DTE option selling. An important note, S-Day, Q-Day, C-Day, Biggie, and Canny are very new funds, like I mentioned, in 2025. And while I hold them, I think the strategies are promising. I want to be transparent that they don't have that long track record. So keep a close eye on these positions and make sure they fit your risk comfort level. And remember, you can see my entire covered call portfolio in the first pinned comment and link below in the description. I show exactly how much I have in each position and my complete allocation strategy. All right, so those are the 10 Canadian ETFs paying over 10% yield that I personally own, plus honorable mention of HHIC. Now watch these two videos for more investing tips. Bye guys.